All right, seeing as it is 3:30, let's go ahead and get started. Welcome, everyone, and happy Economic Development Week. Today, our webinar is Uncovering the Best JobsEQ Analytics for Economic Development. My name is Holden Andrews, and I will be hosting today. Our speakers are our CEO and Chief Economist, Chris Chmura, and then data analyst, Jonathan Cox. If you're new here or just joining us, we generally like to give just a little background into who we are and what we do. So Chmura Economics and Analytics provides labor market data and analysis. That way you can make informed decisions in order to help your community and your business thrive. We were founded in 1998 by Chris Chmura, and there are two offices, one in Richmond, Virginia, the other in Cleveland, Ohio. We are economists, data scientists, statisticians, and business professionals who truly care about helping your community and your business grow. Two things that drive us are client satisfaction and success. And our first priority is that of excellence, both in customer service and data quality. So besides excellence, there are three other ideals that we try to prioritize every single day. And those are being thorough, striving for accuracy, and making sure that our data are useful. These are what guide our organization, and they're what drive us. One way we really try to exemplify these values is through our labor market resources. We believe that everyone truly deserves to have access to high-quality economic analysis, and that's why we offer a lot of free resources. So one of these is our weekly economic update, where each week we send out the most up-to-date national data and analysis it goes straight to your email inbox. So if you're interested in joining that list, I will put a link where you can sign up in the chat. Real quick, before I pass things off to Chris, I do want to mention that the webinar slides and recording will be sent out to all attendees tomorrow. If you have any questions during the presentation, please don't hesitate to put them in the chat. Thank you. Chris?
Great. Thanks, Holden. I just want to stay on this page for a minute because I think now more so than in the past, it's been important to look at economic indicators. And so as we go through the information today, will we see a recession? I'm going to point out some of the data that you're going to want to watch. And when you get this weekly complimentary update, it gives you some of those indicators that will give you a sense of whether we're moving closer to a recession. And also I'm going to explain the Treasury curve and how important that is in terms of whether or not we end up in recession later this year or next year. So very quickly, though, before we start, if you've been on presentations before, you know that we're having a user summit in Cleveland, Ohio, October 9 through 13 at the Ritz-Carlton. You may think Ritz-Carlton, that's going to be very expensive. Actually, it's not very expensive. It's, in fact, a lower price than some of our previous conferences. If you go, you'll be able to attend workshops, network, and hear from data experts. A couple of highlights in terms of speakers. Derek Hilbert, who is the Director of Talent Acquisition at Hanes Brands, which is in Charlotte, North Carolina, will be speaking, as well as Mark Schweitzer, who is a Senior VP in research at the Cleveland Federal Reserve Bank, and he'll talk about some of his research in terms of what are the drivers of regional economic growth. If you want more information, please email Holden, or if you're a client, you'll be seeing information in the mail to delve into that more. So with that, taking a look at the national overview first, where are we in terms of the economy? The first quarter of 2022 came out and it was negative. It contracted 1.4% on an annualized basis. And I don't know any economist who was looking for a negative number in that quarter. And we'll look at that more specifically. The big question is, 2023, will we see a soft landing? That is, will the economy slow then pick back up? Or will we go into recession? And that's, for the most part, dependent on whether inflation is going to start to slow and how far interest rates will rise, how far the Fed will push interest rates up. And I'll explain all of that in just the next few minutes. And then Jonathan will speak about using JobsEQ in economic development. And again, happy Economic Development Week to everyone who's here. So now the national overview. Here's a slide you've seen before. GDP is the broadest indicator of economic activity. The Great Recession was kind of long. It was the longest and deepest recession that we had seen since the Great Depression. When we went into the COVID recession, it was only 2 months long that straddled 2 quarters. So it ended up being in the first and second quarter. And it's the National Bureau of Economic Research that decides when a recession ends and begins by looking at monthly data, some of which I'll show you on the next few slides. We came out rather quickly. Here's that negative quarter, and then our forecast is for modest growth going forward over the next couple of years. That forecast, if you've been watching us, has decreased relative to last month and the month before, mainly because the Fed is now going to increase interest rates more than we had expected, more than they had anticipated. This negative quarter was because of the increase in the Omicron variant, and we saw a very slow growth when Delta popped up. So again, the pandemic continues to have an impact on the economy. We're not assuming any more big spikes as we go forward in terms of the forecast that you're seeing here. So when we look at GDP, it's important to look at the components. And when we look at the components, it's clear that first quarter was an aberration in terms of the decline. So the way to read this is we're looking at the components that make up GDP. And if you took economics, then you remember GDP equals consumption. So that's consumer spending plus investment, non-residential, residential, then inventories are an investment, government plus net exports. So here, again, the zero line, if the component contributed to growth and if the component actually took away from growth, you're seeing it here. One thing in purple, you see that consumers make up about 70% of GDP, so that they're very important. Using this quarter 3 as an example of how to read this. So purple, consumer spending contributed, it looks like about 25% of that 33 percentage points of GDP. So I'm sorry, it contributed 25 percentage points to that 33.8%. Non-residential, residential, and inventory change gave us the rest of that percentage points. And then here you see that net exports actually declined, and it's hard to see, but government actually declined and took away from overall growth. So had government and net exports increased, it looks like we would have seen about 36-37% annualized GDP growth. So then as we move forward now, looking here, it's hard to read this one because that is the first quarter because these other numbers are large. So I'm taking out those large spikes, and now you can look at the latest quarter, first quarter GDP. Here, consumer spending was about 2%. So the consumer sector was fairly strong. That's good news. It's same as we've seen in the last 2 quarters, consumer sector doing fairly well. We also had a positive contribution from non-residential investment. That would be plant and equipment spending by businesses. It looks like government was slightly positive here. But the big decline was because of net exports. That is, we imported more than we exported, and also because of inventory change. Now, some of you probably, or most of you probably know that GDP gets revised 3 times. And 2 of the numbers that are not, that we don't have as much information on are net exports and inventory change. That is, when they create this first estimate, they've only got 1 month worth of data in terms of inventory change and net exports they're looking at. Whereas with some of these other data points, they've got 3 months. So it's a pretty good number. So looking at this first quarter, it looks like an aberration. The consumer sector is still strong, so this does not look like the beginning of a recession. And as you all know who have been with us, around the globe, a recession is defined as 2 quarterly declines in GDP. But here in the US, we've got a business cycle dating committee within the NBER who looks at a bunch of different monthly data to determine when a recession begins and when it ends. So let's look at just a few of the indicators they look at. And when we look at them, there's no sign of recession here. So the gray shaded area is a recession. Here, employment, we saw the big drop because of COVID and people having to work from home, or if they were non-essential businesses, they closed. The latest data, April data is showing us that it continued to grow. In fact, we're about 5% off of the pre-COVID levels. So employment growing says no recession. Industrial production, so output from factories, from mining, from utilities, continued to grow. So this one, again, does not show a recession, and you can see how quickly it fell in the COVID recession. On the right-hand side, consumers make up, again, about 70% of GDP. You can see consumption dropped off. That's spending on goods and services. Here you can see it's up about 2% from a year ago. But when we look at the monthly numbers, it's continuing to increase. Income, you could see that it spiked because of the stimulus money that we were getting here. It's down 10% from a year ago. And again, that's because we're not getting the stimulus money when we're comparing it to a year ago when we did. But overall, again, this does not suggest that we're going into a recession. One point that we look at, and for those of you who have JobsEQ, you can be looking at this on a daily basis, in fact, and that is job postings. So job postings are a leading indicator of employment, because of course, if you feel the economy is slowing down, then you don't try to add workers. And if you're not adding workers, you may take some of your job posts off the books. So here in the US, you can see 41 million active job posts over this time period. And the blue line shows you this year, the gray line shows you last year. So job posts are up significantly over last year, which says to me that businesses are optimistic and don't expect us to go into a recession. So you might want to see, well, what would it look like if we were going into a recession? And so here I'm showing you March of 2019, when the economy was going into a lockdown. Notice job posts dropped off significantly until we got to that point where we were seeing the economy open back up and come back. So again, let's watch these indicators that I showed you on the previous slides: employment, industrial production, retail sales, spending by consumers, job postings, the unemployment rate, and that will give us an indication of whether we're in a recession. One other indicator that some people look at is consumer confidence, and it's not a good predictor of recession. But this is a survey of about 5,000 households done by the Conference Board every month, asking questions of consumers such as, is it easy to find a job? Do you expect it to be easier in 6 months? Are you planning a vacation? Are you planning to buy a car? And based on all this information, they put an index together of how good we feel about the economy, and it's indexed to 1985. When this number is up around 110, people are feeling really good about the economy. Typically, it's not until we go into a recession that it drops off significantly. And this consumer confidence is made up of two parts. That is the expectations. How do you think the economy is going to be doing 6 months from now? And you can see people don't feel as good as 6 months from now as they do about how the economy is right now, the present situation. But again, here, some people look at this as a predictor of recession, but it is not. It typically is coincident with a recession, or it lags going into recession. At this point in time, we're looking at about 110, the index, and this is consistent with an economy that is growing and doing fairly well. So the stock market, it's another one that predicts recessions, but as some people have said, the stock market has predicted 8 of the past 5 recessions, and that is, it overpredicts. But for most of these indicators, or for the NASDAQ and the S&P 500, in bear territory right now, but I wouldn't take this to mean that we will be in recession. It's something that sets off some alarms, but oftentimes stock market will overpredict whether or not we're in recession. One indicator, though, that I'm watching most closely as a forward predictor of recession is interest rates. And they tend to be a good predictor, and I'll get into that on the next few slides. But here, the federal funds rate is the only rate that the Fed can directly affect. And it is the rate that banks use to loan to each other on an overnight basis. When the Fed pushes that rate up, and you can see they did that 50 basis points or half a percentage point at their last meeting, the prime rate goes up lockstep with it. So if you have loans that are tied to the prime rate, they're going to become more expensive as the Fed continues to raise rates. And then you see the 10-year bond going up, and its interest rate typically goes up when we see higher inflation. And typically also when the Fed is raising rates, it goes up. So how do we learn from what the interest rates are telling us right now? And we do this by looking at the yield curve. So here's the yield curve for those of you who aren't used to looking at this. It's at the bottom here, you can see maturities. So a 3-month maturity is almost zero. The 5-year maturity, it looks like it's about 0.75%. 10-year maturity up above 1.5, and then a 30-year. So you require higher interest rates to hold a bond for a longer period of time. And this is what it looked like a year ago. When it's steep like this, it's considered to be stimulative. The more shallow or narrow it is, it's more restrictive. So here it was a year ago, and here's the interest rates a week ago here in green, and then last week on Friday in orange. And you can see that it has flattened. We've seen the federal funds rate start to increase, and then we see the 1-year, the 3-year. As these rates go up, then we're seeing car loan prices going up. As the 10-year goes up, you're seeing mortgage rates going up, and that has significantly. And typically, the yield curve will invert before a recession. So what we mean by that is that this short end of the curve, which is typically lower than the long end, continues to go up because the Fed is raising interest rates, and they raise interest rates so much that you end up with the short end here, maybe in the 4% area, and the long end is out still lower than that. So that historically has been the best predictor of recession. So then the question becomes, well, how much do we expect interest rates to go up at the short end versus the long end? And the Blue Chip Financial Forecasts is a group of about 45 economists or so that are asked to contribute to this monthly magazine to give their forecasts. And Xiaobing Shuai and I participate in this, as well as other bank economists and national economists. But in terms of expectations, in the fourth quarter of this year, the federal funds rate, the person with the highest forecast is looking for 3.1% by the end of the year. And again, we're around 1% now. The consensus, or the average of all of the economists, is 2.2. Looking for the Treasury to continue to go up. 3.1% is the consensus where we'll be at year end, which will mean the mortgage rates are about 5.2, which is about where they've been floating right now. These forecasts also go out to the third quarter of 2023, where the consensus is that the federal funds rate target will be 3%, the 10-year 3.3%. So see how that's starting to narrow, and the 30-year mortgage at 5.4. These forecasts were submitted on April 29 to the Blue Chip magazine. So if we do end up seeing this sort of forecast, what will that look like? So I took that 30-year forecast from the consensus, and it looks to me like a soft landing. So you see, we've got the federal funds rate was down around 3%, and then the 3-month will be just actually the federal funds rate was around 275, so the 3-month will be just a little bit above that, and you can see how rates go up over time. So the big question is, will we actually see the Fed having to raise rates more than they said, and will this curve invert? So some background then, one of the very important things that the Fed is looking at is inflation. So here you have the Consumer Price Index from the BLS, and this is through March. April came out yesterday, and year over year it was down just slightly, but still a very high number. The PCE is the Personal Consumption Expenditure Index. That is the Fed's preferred number to look at. And here you could see it's nearly up to 7%. So anyway, we look at it, we're seeing interest rates going up on a year-over-year basis. When interest rates go up, when the Fed really becomes concerned is when they start to see wages going up. So in this case, it may be seen as a wage price spiral. That is, if we see inflation going up, then employees are going to ask for bigger increases in their pay. If that continues, then we can see inflation staying with us longer than the Fed had expected. So with that as background, what is the Fed saying in terms of where are they going to stop increasing interest rates? And they say currently that they're going to take us to the neutral federal funds rate. So then the question becomes, what is the neutral federal funds rate? And it is theoretically, and I underlined it and made it italics and bold because it's a theoretical number that is neither accommodative or restrictive. So when they get to that rate, it's not going to slow things down, and neither is it going to cause people to invest more. It's about 2.5% based on comments that the Fed have said. So what we understand is the Fed is going to try to get the federal funds rate to 2.5%. And then if the economy starts to slow, then they probably won't raise it any further. But if the economy continues to grow at a fast pace, inflation remains high, when they get to 2.5, then they're going to continue to push the federal funds rate higher. This is even more difficult in terms of this theoretical rate because it's based on longer term inflation. So if inflation gets back down to their 2% target, then the neutral rate is lower than if the inflation rate gets back down to 3% and stays there for a while. So this is a moving target in many ways that the Fed is trying to get toward. And there was a great article late April in the Wall Street Journal called Neutral Fed Rate is a Moving Target. So for those of you who want to read more about that and understand how they come up with that rate and how much it may be off, this would be a great quick read. But just yesterday, Bill Dudley, who was a former New York Fed president, had an article in Bloomberg, an editorial, saying that based on the way that he would calculate the neutral rate, it's probably 4%. So Bill Dudley believes that the Fed is going to have to move the federal funds rate target to 4% just to get us to a point where their policy is not stimulating economic growth. If the economy continues to grow, then they'll have to push it above 4%. So what would that look like in terms of that yield curve that we were looking at earlier? If Bill Dudley is right, then we'll see the Fed pushing up the federal funds rate to 4%. So then the big question becomes, well, what's going to happen with the rest of the curve while the Fed is pushing up the federal funds rate? Will it just inch up a little bit so that we'll end up with an inverted curve? Or will the economy start to slow and then we'll end up with the soft landing? So in my view, well, I think I've given you enough that you can now watch the data that's coming out and decide for yourself, are we going to end up in a recession? And as we continue to see more data, determine whether we're getting closer to a recession. So as I look at all these indicators, typically the Fed is not able to get us to a landing, a soft landing, and we end up in recession. So from that perspective, and as I look at all the data, and as I think of how fast will the Fed raise rates, I'd say that it's highly likely that we'd see a recession by the end of 2023. But you all now have the background, and so you can determine for yourself whether we're going to get a soft landing, that the Fed's going to be able to pull this plane back up and get the economy growing again as they just inch interest rates up, or if they're going to have to push them up further than expected and we end up in a recession toward the end of next year or thereabout. So with that, I'm going to turn it over to Jonathan. But before I do, just wanted to mention that for those of you who do use JobsEQ, we have a FIT certification that's really helpful to help you hone your expertise, become more efficient in using JobsEQ. And if you're interested in that, you can do it online, or you can get the FIT certification in person if you attend our conference. But with that, let me turn off my stop sharing and let Jonathan take over.
Hello, everyone. Let me start sharing my screen. This one, there we go. All righty. Hello, everyone. My name is Jonathan Cox. I am a product trainer / data analyst at Chmura. And thank you, Chris, for that wonderful presentation. Definitely look things like there might be storm clouds on the horizon. So in celebration of Economic Development Week, I'm going to discuss key tools / analytics that economic developers should know about in JobsEQ. So one key tool in JobsEQ for economic developers are these economic development workflows in the economic development, the JobsEQ for economic development product that we have here. And what we've done is sort of taken common research questions that economic developers may have and built in step-by-step guidance around how you can use JobsEQ to answer those common research questions. So for example, let's say your research question is to identify industries you should prioritize developing. That one right there, you can click that tile. And then you can see 3 different steps you could take to answer this research question. And, for example, you could, under perform industry analyses, you could click, or you could run the industry snapshot analytic here to find high growth and high wage industries. And if you take that step, you can see up top, here, what I'm going to say, but you can see up top, there's going to be this text next to the light bulb explaining how you can identify those high wage and high growth industries. So, sorting by the employment growth column or the average annual percentage growth rate column in terms of forecasting data, or identifying current strengths using that sort of location quotient column there. So, sort of looking at these different workflows, or where we give you that step-by-step guidance around how to answer common research questions in the economic development sector is very helpful. And so I just want to make sure you all are aware of those, this option or these tools are available for you before sort of diving deeper into some more specific data. But generally speaking, there's 2 primary ways economic developers tend to use JobsEQ. One, they use it to conduct more short-term analyses, such as responding to RFIs / RFPs or grant proposals. Or 2, they use it to conduct more long-term strategic analyses, such as determining which industries or occupations they should invest in growing, or skill gaps analyses and things along those lines. I'm going to show you some key analytics first. I'm first going to show you some key analytics that are useful to responding to those RFIs / RFPs. So one of the first things you can do that is useful is creating a custom region. So you can look up, you can better capture data that sort of matches the labor shed or the area an employer will draw workers from in your region. So the way you would go about creating a custom region to use within JobsEQ is by clicking this little person icon in the upper right-hand corner, then selecting region. I'll take you to the settings menu here, and you can click create new region. And here, you could create a drive time. I'll create a drive time for our office here in Cleveland. I'll do 45 minutes. But I can switch this region resolution to, these are sort of the building blocks from how I'm going to create my custom region. So I can build it out of counties, ZICTAs, census blocks. for this quick example here, I'm going to build it out of ZICDAs, which are like zip codes. And then if I wanted to build a drive time region for our Cleveland office here, I'll put in 45 minutes. Then our address here, which is 25 here on road. And Cleveland, make sure I spelled that right. Cleveland, Ohio. And if I click run there, get our sort of 45-minute drive time here and save that. And then I have a custom region where I can sort of pull data for this 45-minute drive time here. So, if I have an employer moving to that specific address, I can sort of see labor market information within that 45-minute drive time. So sort of the types of people, sort of the type of occupations people are employed in within that 45-minute drive time to get an idea of sort of my available workforce, things like that. So in addition to sort of creating these drive time regions at this sort of ZICDA level, another thing you could do is, using our census block data, you could create a custom region for a city council district. So here I found the FIPS codes for the city council district 6 in Richmond, Virginia. So I could run data. I could use this custom region to find data for city council district 6. So we'll run with this example for a bit. So if I click run analytics here, it brings up this window, and this can show me all the different analytics or some common analytics I can pull data for this custom region. So if I go to the demographic profile analytic, here I can find demographic information for this custom region. So, here I have a population estimate for City Council District 6 in Richmond, Virginia. I can see some gender splits information, age distribution information, race and ethnicity information. You can scroll down and see some economic characteristics like labor force participation rate, some median household income data there, educational attainment data. You can see some social characteristics like poverty rate and number of households receiving SNAP. So this can be useful for sort of giving you that demographic information if you're responding to grant proposals or something like that. I could also plug in our drive time region that I just created. So Chmura drive time. And if I switch this to the region stats table here, oops. Let me refresh that real quick. There we go. And then, oops, I'm going to switch this to region stats. So here, I come down, I can see some information around electricity rates or union membership rates. So, there's a lot of interesting data you can sort of pull in the demographics section for these custom regions. You could also go to the labor in weights trend analytic here and pull up historic industry employment trends or view cost of living data. So here in this employment data set, I can see, for example, if we look at manufacturing employment, I can see, how this data has changed since 2002. This gray bar here represents that 08-09 recession there, and you can see there was a big dip in this custom region in manufacturing employment there in that 08-09 recession, the Great Recession, and then don't see too much of a bounce back, unfortunately, but you can see some. And then this bar here represents the COVID recession there. But you can see, there was a dip here, but there's signs of sort of returning to those pre-pandemic levels of employment, at least in the manufacturing sector here. So, you can pull, like I said, some employment data for a custom region. You can switch this to the cost of living data set and view cost of living data here for a drive time or custom region. So that's possible. So that's some more data you can pull for a custom region that can be helpful to responding to grant proposals or RFIs. You can also view wage data for a custom region. So you can go to the occupation wages analytic here. And here if I switch this to the 6-digit SOC level, apologies, taking a little while. Actually, and we'll go ahead and narrow this down. We'll do food prep and serving related occupations here. So here I can see, not just the mean and median wage for an occupation in our region, but I can see the entry level wage, experience level wage, as well as the sort of full distribution by percentile. I can see here that 75% of fast food cooks employed in my drive time here earn $28,300 or less. So 25% of them are making greater than $28,300, but 75% of them are earning this wage and less. And if you want, you can convert this to hourly wages. So it's possible to view the wage data this way. In addition to sort of viewing this data to provide these percentile distributions here, you could switch this to the labor availability query type. This is a really useful tool because it shows you how many people are making above or below a certain wage threshold. So this can be useful when you're working with an employer, because if they're planning on coming in offering a certain wage, you can tell them how many people are currently making above or below that certain wage. So if I put in, let's say, $14 here an hour for these food prep and serving related occupations, I can see how many people are making $14 an hour or below, and how many people are making greater than $14 an hour. So, like I said, maybe you're working with an employer, and they say that, hey, we're planning on offering this wage. You can come in here and tell them, hey, that wage you were offering is a lot higher than people are used to earning here in these certain occupations. So you should have a lot of people willing to work for you. Or it could sort of be the opposite scenario, where you might want to think about increasing those wages to attract more workers. This can also be useful for, once again, sort of your living wage, prevailing wage studies, showing you sort of which occupations are earning a living wage in a region or not. And so that can determine which ones you want to target or something. So that can be a useful tool. But one of the more useful analytics or key analytics to responding to RFIs within JobsEQ is this what if analytic here. And what this does is it performs a labor availability analysis, telling you whether your region can meet the staffing needs of an incoming firm. So I'm going to work through an example. At the beginning of the year, there's this big announcement of Intel opening up a new sort of semiconductor chip plant in Ohio. So I'm going to just work through that example. So they were earlier, I created a custom region for the new proposed site. So I did a 60-minute drive time around this proposed the proposed site for this chip factory that's coming to Ohio. And then I will look up the industry that this chip manufacturing firm sort of operates in, the NAICS code. And I found that to be 334413. So semiconductor and related device manufacturing. And then once the plant is up and operating, they said they'll need about 3,000 workers. So that's what I'll put as my firm size there. So I run this analysis, and what's produced in this table is what we called a staffing pattern. And so based on sort of 2 points of information in terms of what industry that the firm is operating in, so the semiconductor and related manufacturing industry, and how many workers are going to need to hire, 3,000, we estimate which occupations will most likely need to hire for this column here, and how many of those occupations they'll need to hire, how many people they'll need to hire in those occupations. The next few columns on this table sort of discuss labor availability to fill these positions. So we got employment by place of residence and unemployment. And if you add these two columns together and divide it by this new employer demand column, you get this potential candidates per an opening column here. And the way this color ramp works is if it's a number greater than 50, you'll get this green color. If it's a little less than 50, you get this yellowish color. If it's a really low number, you sort of get this reddish color here. And so this sort of gives you an idea of sort of labor availability to fill these occupations or not. And you do have a low number in this potential candidate for an opening column. What you can do is sort of look at these employment extended and unemployment extended columns. Here, we've identified occupations that have a similar skill set to this target occupation here, and with a little bit of retraining, could probably step in and become and transfer over into this target occupation. There's some other columns here where we have like the regional average wage and the national average wage for these occupations in the staffing pattern. And if you scroll to the bottom of the table, you can get an estimate of sort of what your total annual payroll is expected to be for the staffing pattern using regional wages versus national wages. So this can also be useful in your business attraction efforts if this regional average wage column is less than the national average wage there. So that's sort of, like I said, this is sort of an interesting tool to give you an idea about whether your labor market, your region can meet the staffing needs for an incoming firm. And one thing or one interesting finding that we see here is that our current labor supply here of electrical, electronic, and electromechanical assemblers are a little bit less than what we ideally would want to have here to fill the staffing pattern. One thing you could do or sort of investigate further is maybe you could see, in addition to looking to retrain people to step into this occupation, it might be good to investigate what the talent pipeline for that occupation is currently in our region. And if you wanted to investigate that further, one step you could do is click a hyperlink for the occupation here. This will pull up this box, and if you click the awards analytic here, you can see for post-secondary schools in our region here, you can see what the amount of degrees being conferred in programs related to our occupation here, electrical, electronic, and electromechanical assemblers. So you can see here in the 2019 to 2020 academic year, there were 414 post-secondary degrees conferred in programs that are related to this electrical, electronic, and electromechanical assemblers degree. So although the amount of people currently employed in this occupation is a little lower than like what we would ideally want for our staffing pattern, we can sort of see that we do have a pretty good, robust talent pipeline there. So we may not have to worry about sort of expanding existing education programs too much to meet occupation employment demands in the future. So, overall, when we sort of look at the staffing pattern, you can get an idea of, the Columbus region where this Intel chip factory is planning to come into or sort of open up operations. This Columbus area seems like it's pretty well prepared to meet the staffing needs of this incoming firm. So like I said, the what if analytics is a pretty useful tool for sort of responding to RFIs and RFPs and stuff like that. Okay, so next I want to talk about more long-term strategic analyses in JobsEQ. So there are many analytics in JobsEQ that it can assist with long-term strategic planning, like the shift share analytic or the supply chain analytic, clusters, etc. However, right now I want to focus in on our job posting database, job posting database analytic, RTI, which stands for real-time intelligence. And we create this database by this job posting database by crawling the internet daily for online job posts. We grab job posts from over 40,000 different sources, from job boards like Indeed to staffing company websites to individual companies' websites. We'll go to a company's website directly and grab job posts from there. And once we have this large set of job posts, we then deduplicate them amongst each other. And we then have a model that's able to read the text of a job post and assign it to a specific SOC code, as well as pick out other things mentioned in the job post, like certifications being requested, hard skills, soft skills, minimum education level being requested by the employer, a bunch of things. So here in the RTI analytic, you can see job postings grouped by all these different categories. And thus this database is really a great way to sort of see or get an in-depth understanding of what employers in your region are requiring of applicants or of your workforce. So I switched my region here to the Cleveland MSA, and I'm going to switch my job added status to newly posted, and we'll see job posts that were posted at some point in the last 12 months here. And looking at this here, we got 243,334 job postings in this initial query here. And as I'm looking at the way the job posts are grouped, you can see them grouped by occupation here. I can see the occupation with the most number of job ads was this registered nurse job posting, or this registered nurse occupation. If I click that hyperlink there, I can see specific information around these job postings. If I click, let's see here, we'll do this one. You can see here, this is a job posting for a registered nurse at University Hospital. So you can see specific information around that job posting. But so you can see, like I said, you can see which occupations have the sort of highest volume of job postings here in our time period. There's some additional data you can see here. If I click that wages box, I can see for the job post where we're able to identify wage information, we can see what the median wage is for these different occupations, so that can be useful. You can switch that to hourly. You can add this median duration column here. So this can give you an idea of whether a job post or a particular position is hard to fill. The higher the median duration indicates that the longer it takes for a job to be closed or taken offline. So like I said, this can be a good indication of whether a particular occupation is hard to fill in your region. Ads closed can give you an idea of how many job posts have been closed in your region for that particular occupation. So that can be sort of maybe a proxy for hires. And then you can use this job posting location quotient to estimate which occupations are more demand in your region compared to the nation as a whole. So, so this is sort of interesting. You saw that the raw number of job postings for registered nurses was the highest in the Cleveland MSA here. But when we look at the job posting location quotient, compared to the nation as a whole, this isn't the percentage of job postings in compared to its employment size in the Cleveland MSA economy is actually smaller than the percentage of job posting for registered nurses in the national economy. Thus, the registered nurse job postings in Cleveland are not in high demand necessarily when you factor in employment compared to elsewhere in the nation. So that could be sort of an interesting finding. Here we see first line supervisors of retail sales workers. Seems like there's a lot of job postings for this occupation compared to its employment size there. So that's kind of interesting. I guess there's a lot of turnover here, so that kind of makes sense, probably not occupation, but you can search here and see which occupations have high job posting location quotients. The other thing you can do is, besides these additional columns, right, is you can filter your query by any of these categories here on the left-hand side. So all these different ways we can group job postings. And, for example, if I put in a location query or a location filter here for Solon, Ohio, I can view all the job postings that we have listed here for Solon. And if I go to the employer section here, I can see, oh, this is kind of interesting. A lot of the job posts in our query here come from Nestle, which is headquartered here in Solon, Ohio. And same thing for Swagalock here. So, you can look for a specific city and see which job posts, the type of job posts that are being posted there. And you can also see different characteristics around these job posts. So, you can go here and see the different certifications that are being mentioned in our 4,645 job posts here, different type of hard skills, soft skills. Another thing you can do with these filters is perform maybe a long-term trend analysis for the mention of certain skills in job postings or certifications. For example, I could do a multi-year query here. So I'll kick this back to January 1st, 2019. And then let's say I wanted to, in the software developer world, there's always a debate about which programming language is reigning supreme at the moment. So if I want to do a long-term trend analysis in the number of job postings and see which ones are mentioned more, Java or Python, what I could do here is go to the hard skills section, add a skills filter for Java, come here and add one for Python, apply that, come up here. I'm going to actually switch this frequency to monthly, and then export this as a time series. And here we got Java, Python up top. I can see over like my 2 or 3 year span here that there's more job postings for Java than Python. And I can see that sort of on a monthly basis, the volume of job postings. However, one sort of interesting thing is if you scroll here to the end, and maybe, so the top one is Java here. So we see there's 1,393 job postings here for Java. Well, if we look at in 2021, if we look for Python, we see that there's actually more job postings in Python in 2021. So that's kind of interesting. You can sort of see maybe there's becoming an increased demand for applicants to know Python rather than Java. So, that can be an interesting, like I said, you can perform these long-term trend analyses and skills. You can also do the same thing if you come down to the job types here. You can do a similar thing for these different characteristics. If I add a filter for remote job posts, and then let's say I switch my period here to 2020, the chart up top shows me volume of job posting trends for job posts that mentioned for remote job posts. Oops, let me remove that hard skills filter from remote job posts. And you can see here, the gray line is 2019, the blue line is 2020. You can see there was an increase in the volume of job postings, indicating that remote work job postings. So you can perform a lot of interesting trend analyses here in RTI and other analytics within JobsEQ. So that sort of wraps up the end of my spiel, but like I said, this gives you an example of some key analytics that economic developers use within JobsEQ.
Thanks, Jonathan. That was great. Very useful. I even learned a few things I didn't know about there. So we do have a couple of questions here. One of the questions was that came on my side. Let me get it back open. Is what are 3 things that the federal government can do to reduce inflation and avoid a recession? Unfortunately, it takes 6 to 9 months or longer for the Fed's increase in interest rates to have an impact on the economy. So they're behind the curve. That's one of the reasons why some people like myself are looking at the probability of a recession rising over time. And there are things that the Fed can't directly affect. So, for example, the Ukraine war, shutdowns in China have caused more problems to the supply chain. So that's something out of their control. But certainly getting the federal funds rate to 2.5% sooner rather than later is something that will help. A second thing, we all want to see a shift toward green energy, but I think we're moving toward it too quickly. We need to have more oil and gas that's extracted in the short term will help keep inflation lower. Third thing, we don't need any more federal stimulus. So the reducing student loan debt, for example, would be stimulus that would add to inflation. And then reducing regulation is something overall that helps to helps the economy to grow faster. Then we had a question about where are the people to fill the jobs? Well, some of them have retired. Some of them who have retired are coming back because of inflation. They can't live on their fixed incomes right now. Some more women have left the labor force than men, apparently because they're caring for children. So the more we get daycare opening back up and affordable, the more we'll see some help there, and as well as kids being in school full time, back in school, that is, physically in school. 16 to 21-year-old participation rates have declined as well, and some of them going back to school to get more degrees. Some other things now that we're starting to see, something called long COVID. So some people that have gotten COVID and they've had other issues before getting COVID are finding that they're basically not able to go back to work. So we're looking at something like a disability, although long COVID has not yet been labeled a disability like some others, like some other disabilities. The opioid crisis is also contributing. In fact, the Federal Reserve economist who's speaking at our conference has done some work on that. He's a labor economist, and that would be a great question, I think, for him to address a little bit when he speaks at our conference in October. And then there was one other question about retirement. Now, Jonathan, if you can help out here, and that is, if more people are retiring, then there are more positions open that should cause job openings to increase. And yes, I would expect that to be the case, although I don't believe, Jonathan, that we can identify within our job postings how many of them are being posted because the employers are trying to refill a position where someone's retired.
Correct. Yeah, we can't do that in our job posting data. However, elsewhere within JobsEQ, we do we do forecast job demand in the future due to retirement or other separations due to people leaving the labor force, like maybe someone having a child and deciding to become a full-time stay-at-home parent, or people going back to school. So you're absolutely correct. In our job posting data, it's sort of how it's difficult to indicate whether this is because this job post is being posted because somebody's retiring or not. But we do forecast how much new employment is expected to grow due to refilling existing occupations, or how much is actually like new employment growth, like in industry sector employment overall increasing.
Awesome. And then so there was another question that came through asking about skill gaps. So I guess Jonathan and Chris, in terms of digital literacy skill gaps, what are the needed skills forecasted for that?
So Jonathan, on that one, I thought it might be useful if you can pull back JobsEQ real quickly and look at the skills gap, and maybe pull open like an IT occupation and look at the skills gaps perhaps in San Francisco and the skills gaps in Cleveland to see how they might differ and how you can identify those skills gaps in JobsEQ.
Yeah, sure thing. Let me make sure my mic's on. Yep, okay, mic's on. So digital, well, I'll first do a preference. Digital literacy, it's sort of like an ambiguous term. So it's so if you do have, let's say, RTI, it's not going to show up like digital literacy. It's not going to show up as like a hard skill or like a soft skill, like a regular sort of soft skill or certification. You could use a keyword filter here to see which job posts mention that specific phrase, digital literacy, is one way to sort of tackle that there, as sort of finding those specific job postings. But If you're going to use the skill gaps analytic, it would be best to maybe identify what the specific skills you're looking for. But here in the skill gaps analytic, the way we create this data, or this sort of the data behind this analytic, is we take a 1-year sampling of the job posting data we're just viewing, and a 4-year sampling of our online resume database data, and we run it through our model, and we basically cross-reference which hard skills and certifications are showing up in our job posting data in a region, and which hard skills and certifications are showing up in our resume data in a region, and sort of cross-reference the two. So here, for like the Cleveland MSA, I can see sort of different skills gaps, sort of the top 10 and top and bottom 10 here. So the red, here represents gaps. So where we're seeing more job posts than that mention that sort of skill rather than resume data, and then vice versa here, we're seeing more resume data with these specific skills than job posting. If you you can put in a different region here. So let's say we do Chicago. You can see the data slightly changes there. You can look at it for a specific occupation. So if we do like software developers here, you can see this is a skill gap for software developer occupation in the Chicago MSA. Switch this here to Cleveland, I can do it there. If I switch it to San Francisco, you can see that there. So you can perform sort of a skill gaps analyses here and sort of see that thing there. But sort of defining how you sort of coming up with the definition for digital literacy or something like that will help you gain greater insights from the data that you're looking at in JobsEQ.
And Jonathan, just to kind of, I guess, clarify a little bit, they said digital literacy includes more than just IT positions. Is there a way to do an analysis of skills for a region? And you may have, answered that while you showed skill gaps, but could you speak on that a little?
Yeah, I mean, exactly. So it is possible to do an analysis for skills for a region. Right here, you can just select all from this filter and total all occupations. Here, I selected certifications there, but I can do hard skills or something like that, and you can look at the gaps this way. So these are all the skills, I'll switch this to skills just so I can say the word skills. Here's all the hard skills here, and sort of the gaps that we have present here for the San Francisco MSA. So yes, you can use the skill gaps analytic to do exactly that. See sort of the skill gaps for the entire region, and there's a couple other different query types there. Hope that answers your question.
One more quick one, Jonathan, before we wrap up. Can there be multiple keywords in a given search for the, I know that's possible with RTI, but is that also possible with skill gaps? Oh, sorry, in an RTI search specifically, can you search with multiple keywords?
Yep, you can definitely do that. And let me, I know I'm going back and forth between sharing my screen so much, but if just a great resource for sort of writing more advanced keyword searches is if you click this question mark icon in the upper right-hand corner and scroll down here, there's this guide here about all the sort of different advanced queries you can write. So it works like your typical Boolean search where you can do and or statements, you can do minus stuff. There's a whole bunch of fancy queries you can write using that keyword search in the RTI analytic. And if you ever need additional assistance for writing those more advanced queries, please don't hesitate to reach out to us via the live chat here.
Awesome. All right. Well, seeing as we are at 4:30, I think we can call it right here. But just a quick reminder that I will be sending out these slides and recording tomorrow afternoon. And within the slides, all of the links to the speakers that Chris referenced and anything where there might be more information, those links will be active where you can access the same content that we're using and seeing and all of that. There will also be a recording for the slides, or a recording of Jonathan's lovely JobsEQ kind of tour, if you will. So again, thank you all for joining. And one final happy economic development week. Again, thank you and have a great rest of your day.